As of 1:42 p.m. Eastern Time on this Monday, October 27, 2025, BigBear.ai Holdings, ticker BBAI, is trading at $7.08 per share. That's a gain of about 3 cents on the day, or just under 0.5%. But that flat-looking price hides the absolute chaos happening under the surface. The stock opened near $7.02, immediately plunged to a low of $6.87, and has since ripped back to a high of $7.32, all while trading on staggering volume that has already exceeded 110 million shares. This is not normal market behavior. This is a battlefield. And what most people watching this name right now are missing is that this fight isn't about today's airport contract press release. The real, hidden tension is a direct result of the company's original private equity backers, AE Industrial Partners, dumping their entire 27.4 million share position. A move that was quietly absorbed by high-frequency trading firms and passive index funds who are now churning this stock at a rate of nearly 100 million shares every single day. The retail expectation of a simple AI-fueled rocket ship is colliding with the institutional reality of a massive, high-speed ownership transfer in a company facing a fundamental crisis. Let's establish the common ground, because the narrative around BigBear.ai is incredibly compelling. The expectation is that this is the next Palantir, a smaller, more agile, pure play on defense and intelligence-focused artificial intelligence. Investors see the stock's incredible 300% run-up over the past year and assume it's on an unstoppable trajectory. They see the recent announcements, like the partnership with T-Second for Edge AI on the battlefield, or the deployment of their biometric system at O'Hare International Airport, and they see validation. The belief is that in a world demanding AI-driven security and logistics, BBAI is perfectly positioned to capture billions in government contracts. This is the story that gets told on forums, the story that fuels the hype, and it's the reason why any dip is seen as a buying opportunity before the next parabolic move. The expectation is that the market is simply recognizing the future, and that the stock's small float and high short interest are just fuel for an inevitable squeeze. But the reality of the situation, the one reflected in the company's own financial reports and institutional filings, paints a much darker and more complicated picture. The entire bull case was fundamentally broken on August 11, 2025, when BigBear.ai released its second quarter earnings. The market was expecting growth. Instead, the company reported that revenue had decreased by 18% year over year. The top line was shrinking. Management then took an axe to their full-year guidance, slashing their 2025 revenue projections from a range of $160 to $180 million all the way down to $125 to $140 million. To make matters worse, they completely withdrew their guidance for adjusted EBITDA. This wasn't a small miss, it was a catastrophic failure of execution, which they blamed on lower volume on certain Army programs. This one line confirmed the single greatest fear bears had, that BBAI is not a scalable software company, but a low-margin government services body shop completely dependent on a few lumpy, unreliable contracts. The recent 300% stock run-up you've seen? It has happened despite the company's core business showing signs of a dramatic slowdown. The price action and the fundamental performance are moving in completely opposite directions. This brings us to the staggering volatility and the 110 million shares traded today. This isn't just retail enthusiasm. The Q2 institutional filings revealed the whale movement I mentioned earlier. AE Industrial Partners, the private equity firm that brought BBAI public, sold its entire 27.4 million share position. This is the insider, the smartest money in the room, deciding to cash out completely. And who bought those shares? The filings show massive new positions from Vanguard and BlackRock, which is normal as the stock enters various indexes. But more importantly, quant funds like Citadel Advisors and Renaissance Technologies, firms that thrive on volatility, not long-term fundamentals, established huge positions. The BBAI you are watching today is no longer a growth investment. It has become a high-speed trading vehicle for institutions, and retail traders are just along for the ride. The massive daily volume, averaging over 95 million shares, isn't a sign of conviction. It's the signature of algorithmic churning. Now, let's talk about the element that has so many traders excited, the short position. This is a critical piece of the puzzle and demands a detailed, responsible look. According to the most recent official data from the NYSE, as of October 15th, there are 76.75 million shares of BBAI held short. This represents just under 18% of the company's public float. On the surface, 18% is a very high number and is the textbook definition of a heavily shorted stock. The retail expectation is that this is a powder keg. Any piece of good news, like the O'Hare contract, could ignite a massive short squeeze, forcing all 76.75 million shares to be bought back, sending the stock to the moon. This is the narrative that drives the diamond hands and the calls to squeeze the shorts on social media. But the reality of the short data is far more nuanced and, frankly, far less bullish for the squeeze thesis. An 18% short interest is only one part of the equation. The single most important metric to look at is the days to cover. This metric, which you can find on most financial data platforms, divides the total short interest by the average daily trading volume. For BBAI, the 76.75 million short shares divided by the average daily volume of over 95 million shares gives you a days to cover of just 0.80. That is less than one single trading day. This means that, in theory, every single short seller could close their entire position and buy back their shares in less than a day's normal trading without causing a significant price spike. The shorts are not trapped. The astronomical volume, fueled by the quant funds, is giving them all the liquidity they need to get in and out at will. Furthermore, we must look at the cost to borrow. When a stock is difficult to short and demand from bears is high, the borrow fee rate spikes. For many meme stocks, this rate can skyrocket to 50%, 100%, or even 500% annualized. For BBAI, the current borrow fee rate is a paltry 0.69%. That is not a typo. It is incredibly cheap and easy to borrow shares to short. This tells us that despite the high short interest, there is no panic among the shorts and no scarcity of shares to borrow. So what's your take on this 18% short interest when the borrow fee is so low and the days to cover is less than one single trading day? Is this a case of smart bears correctly identifying the fundamental gap, or is the data itself a broken signal? The evidence suggests the shorts are positioned comfortably, betting that the upcoming November 10th earnings report will be another disaster and validate their thesis. They are not afraid of a squeeze. This doesn't mean the retail narrative is entirely wrong about market mechanics. The fails to deliver, or FTD data from the SEC did show some very large spikes in late September, with over 1.8 million shares failing to settle on one day. This data absolutely points to stress in the settlement system and is a valid point of frustration for investors who feel the rules are not being applied equally. However, an FTD spike is a symptom of volatility and heavy shorting activity. It is not by itself a catalyst for a future price move. Chasing FTD data alone is a dangerous game. For anyone new to this name, after all that, let's briefly cover what BigBear.ai actually does. The company provides artificial intelligence and machine learning solutions primarily for the U.S. government. Think decision intelligence, predictive analytics, and autonomous systems for the Department of Defense, the intelligence community, and federal civilian agencies.
They use their platforms to help these complex organizations sift through massive amounts of data to make faster decisions. For example, managing army logistics or identifying security threats. The problem, as highlighted by their Q2 report, is that this appears to be more of a high-touch, low-margin services business than a high-margin, scalable, software-as-a-service SaaS platform. Every new contract seems to require significant new engineering work, which limits profitability. The O'Hare Airport win is great public relations, but the market is skeptical that these small commercial wins can ever be large enough to offset the dependence on lumpy, shrinking Army programs. So, as we watch BBAI churn wildly around the $7 mark, the conflict is clear. The public expectation is that of a disruptive AI innovator, a high-growth stock on the verge of a massive short squeeze. The market reality is that of a government services company with shrinking revenue whose original backers have fled and whose stock has been turned into a high-volume